All right, so let's jump right into things. Today, we're going deep on HDFC Bank and how they did in Q3 of fiscal year 2025.
That's good.
We've got some great sources here, a regulatory filing straight from the Bombay Stock Exchange and the bank's own presentation deck.
Oh, nice. A pretty complete picture then.
Exactly. We're talking record profits, tons of new branches, and some really interesting details about some of their subsidiaries, like HDFC Life Insurance and HDFC AMC.
HDFC Life, huh? They've been making some moves lately, haven't they?
Yeah, they have. We'll get into all of that. But first, the big headline. HDFC Bank pulled in a standalone profit of $167.4 billion this quarter.
Wow.
That's a 2.2% increase year over year. Pretty impressive.
Especially in this economy. Holding their gross non-performing asset ratio at 1.42% is really something.
For sure, a good sign they are managing risk well. Oh, and the consolidated profit, including all the subsidiaries, was even higher.
How high are we talking?
$176.6 billion really shows the strength of their subsidiaries.
Absolutely smart strategy to diversify the revenue like that.
So what's fueling this growth? Well, deposits are up a huge 15.9% year over year.
Really?
Yeah. Average deposits hit $24,528 billion.
That's a lot of trust from customers putting their money there.
Exactly. And it's not just deposits, advances are also looking good.
How so?
Well, their average assets under management are up 7.6% year over year,
Nice steady growth.
hitting $26,276 billion. And that growth is balanced between retail and wholesale segments, so they're not putting all their eggs in one basket.
Makes sense. Good strategy.
Now let's zoom in on a few key numbers that really stood out to me.
Okay, yeah, let's do it.
Net interest income, the bread and butter for any bank, jumped 7.7% year over year, reaching $306.5 billion.
So they're making good money on their lending activities. What about their net interest margin, though? With rates fluctuating so much, it's got to be tough to keep that stable.
You're right, it's a balancing act for sure. But they've managed to maintain it at 3.43%.
Not bad, not bad. Shows they are managing risk effectively.
Now, non-interest income is where things get really interesting. That grew by 2.8% year over year, hitting $114.5 billion.
That's a smart move. Diversifying their revenue streams.
Yeah, not relying solely on lending. And their cost-to-income ratio stayed really efficient at 40.6%, meaning they're keeping costs under control while still growing revenue.
That's impressive. A sign of a well-run organization.
All right, so now let's talk about their loan book.
The elephant in the room.
It's massive. Retail loans alone hit $13,425 billion. That's a 10% increase from last year.
Wow. And what about the split within retail loans?
Mortgages made up a big chunk, $8,171 billion. And on the corporate side, loans reached $8,608 billion with a strong 11.6% year-over-year growth.
Interesting to see that balance between retail and corporate lending.
And speaking of growth, get this. They added a whopping 1,052 branches in the past year.
Whoa, that's a ton. Are they mostly focused on big cities then?
Actually, a lot of that expansion is in semi-urban and rural areas.
Ah, I see. Reaching those underserved markets, good for financial inclusion.
Exactly. So they're not just about profits, they're thinking about social impact too.
That's great to hear.
Okay, I think that gives us a good overview of their performance, but there's a lot more to uncover, especially when it comes to risk management.
Definitely. With a loan book that size, it's essential to understand how they're mitigating potential risks.
Exactly. So in the next part of our deep dive, we'll dig into HDFC Bank's risk profile and see how they're navigating the current economic landscape.
Should be interesting. I'm ready when you are.
All right, so let's dig into HDFC Bank's risk management. Ambitious growth is great, but got to make sure it's built on solid ground, right?
Absolutely. That's the key, isn't it? Balancing that ambition with caution.
Yeah. So what jumps out at you from the data, thinking about risk?
Well, their capital adequacy ratio is a good place to start.
Okay, what's that looking like?
20%, which is really strong. Yeah.
That's way above what regulators require, isn't it?
Oh, yeah, for sure. A good sign they have a cushion to absorb any losses.
So even with all this expansion, they're not overextending themselves.
Seems like they're managing capital well, yeah.
Good to hear. But what about the risk within their loans? That's a massive amount of money out there.
Right. Even a small percentage of defaults would be huge.
Yeah, exactly.
That's where their gross non-performing asset ratio, the GNPA, is important.
So what's their GNPA?
1.42% right now.
How's that compared to other banks? Good, bad?
Actually, it's pretty good, especially considering the size and variety of their loans.
Yeah, I guess you're right.
If you take out the agricultural loans, it's even lower, 1.19%.
Interesting. So they're not just lending to anyone, huh?
It seems like they're being selective, yeah, keeping an eye on things.
Makes sense, and it looks like it's working. Their asset quality is holding steady.
Right. Even as their loan book grows,
Yeah.
definitely a sign of good risk management.
Now let's break down the types of loans they're making. Retail versus wholesale. How's that split?
Well, retail's about 58%,
Okay.
and corporate and wholesale loans make up the rest, about 42%.
So a slight lean towards retail.
Yeah, which, retail loans are generally seen as less risky.
Smaller loans, more spread out.
Yeah, exactly. Helps to diversify the risk.
Right, the classic don't put all your eggs in one basket strategy. We talked about mortgages earlier. Those make up a big part of their retail loans, don't they?
Oh, yeah, about 30% of their total assets.
Okay.
And those are usually secured loans, backed by property.
So less risky for the bank.
Right. They can recover some of their losses if a borrower defaults.
But aren't mortgages sensitive to interest rates changing?
They are, yeah, but HDFC has a good track record of managing that risk.
Good to know. They have systems in place.
So they can maintain a stable net interest margin, even when rates are volatile.
That makes sense. All right, now let's shift gears to those corporate and wholesale loans.
Sure.
They're a big chunk of their lending. What industries are they exposed to there?
Well, it's pretty diverse.
Give me some examples.
Consumer loans, NBFCs, real estate, retail trade, consumer services, financial institutions.
So pretty much everything. Isn't that risky if one of those sectors takes a hit?
It could be, yeah, but it seems like they're doing what they can to mitigate that risk. They cap their exposure to any single borrower at 10.3% of their total advances.
Ah, I see. Spreading the risk around.
Exactly, and they're also lending mostly to companies with good credit ratings.
So they're being selective about who they work with? That's good to hear.
Right, over 75% of their externally rated wholesale loans are AA or above.
So not just any company can walk in and get a loan from HDFC. They have standards.
They do, and they have a whole team dedicated to risk management, constantly assessing and managing potential issues.
Sounds like a pretty robust system. But can any system eliminate all risk?
That's the thing, right? There's always some level of uncertainty, things you can't predict.
Yeah, the economy, regulations, global events, who knows what could happen?
Exactly. But they do seem to have some safeguards in place for those unexpected events.
Like what?
Well, their provision coverage ratio is a good one.
Okay, explain that one to me.
Think of it like a rainy day fund. Money they set aside to cover potential losses from those bad loans.
Makes sense.
And HDFC's provision coverage ratio is currently 68%. It's pretty healthy.
So they've got a nice buffer.
Yeah, exactly, just in case.
Sounds like they're thinking ahead, not just reacting to problems as they pop up.
Exactly. Risk management is an ongoing process, constantly adapting and refining.
It's a moving target for sure. Well, it seems like HDFC is doing a good job of balancing those ambitions with, with being prudent.
It does, yeah. They're not just chasing growth at any cost. It's about sustainable growth.
And ultimately, it's about protecting their depositors, investors, and the whole system.
Absolutely. Responsible growth benefits everyone involved. Speaking of responsibility, we touched on ESG earlier.
Right, their environmental, social, and governance efforts.
Yeah, I think that deserves a closer look, wouldn't you say? Let's dive into how they're integrating those factors into their operations.
Yeah, I'm curious to see what they're doing on that front. Let's do it. Okay, so let's wrap up our look at HDFC Bank by talking about their commitment to ESG.
Yeah, environmental, social, and governance, the big three these days, right?
It seems like every company is talking about ESG now.
And for good reason. Investors and customers are paying attention to it.
Yeah, it's not just a nice to have anymore, it's becoming essential.
Right. It shows that a company is thinking long-term.
Yeah, thinking about sustainability, their impact on the world.
Exactly.
So let's dive into what HDFC is actually doing on the ESG front. What stands out to you?
Well, their carbon neutrality goal is pretty ambitious.
Yeah, they're aiming for carbon neutrality by FY32, right?
Yeah, that's a big one, especially for a bank.
Yeah, it's not like they have factories pumping out emissions.
Right. It's more complex for them.
So how are they approaching it then?
Well, they're focused on reducing their own operational emissions, of course.
Okay, makes sense.
But they're also looking at the emissions tied to their financing activities.
Ah, so like the carbon footprint of their loans.
Exactly. It's about taking responsibility for the impact of their lending decisions.
So they can influence the companies they lend to?
Yeah, encouraging them to adopt more sustainable practices.
Interesting approach, kind of using their financial clout for good.
Right. They're not just a passive lender. They're actively trying to drive change.
They even have a sustainable finance framework to guide their lending.
So they're putting their money where their mouth is, so to speak.
Makes sense. Now, what about the social side of things? What are they doing there?
Well, their focus on financial inclusion is a big one.
Okay, yeah, we talked about their branch expansion into rural areas,
Right, that's a key part of it, making financial services accessible to more people.
reaching those underserved communities.
Exactly, people who might not have had access to traditional banking before.
So, empowering communities through financial access.
That's the idea, giving them the tools to thrive.
And they're promoting financial literacy too, right?
Oh yeah, helping people make informed decisions about their money.
That's great. Knowledge is power, as they say. And they're walking the walk when it comes to diversity and inclusion within their own company too, right?
Absolutely. 26% of leadership positions are now held by women.
That's great to hear.
And it's not just about numbers. They're actively creating a more inclusive workplace culture.
That's important, making everyone feel valued.
For sure. Now, we can't forget about the G in ESG, governance.
Right. What's HDFC doing to ensure strong corporate governance?
Well, they have a really solid framework in place focused on transparency and accountability.
Okay, good foundation.
Yeah, their board has a lot of experience and independent voices.
So checks and balances in place.
Exactly, making sure decisions are made in the best interest of everyone involved.
And they've been recognized for good governance by independent agencies, haven't they?
Oh yeah, they consistently score well on those metrics.
It's not just lip service, they're walking the walk.
Right, it's become part of their DNA.
Yeah, it's woven into everything they do, their strategy, their culture.
It's really impressive to see how they've integrated ESG into all aspects of their business.
It's a good example for other companies, showing that strong financials and a commitment to sustainability can go hand in hand.
I couldn't agree more.
Well, it's been fascinating exploring HDFC Bank with you today.
It really has.
They're clearly doing a lot of things right.
Yeah, and they seem to be on a solid path for continued success.
And it's not just about profits. They're thinking about their impact on the world, too.
Exactly. Responsible growth, that's what it's all about.
All right, that wraps up our deep dive into HDFC Bank's Q3 FY25 performance. Thanks for joining us. We hope you found it insightful.
It's been a pleasure, as always. Until next time.